Hello everyone, and welcome back to the channel where we demystify the stock market's most fascinating phenomena. Ever wondered what makes a stock hard to borrow, and what that could potentially mean for its price action? Today, we're diving deep into a specific case that's been lighting up our hard-to-borrow screener, DSY, Big Tree Cloud Holdings Limited. This stock is currently showing an annualized cost to borrow fee exceeding 700%, and we're going to break down exactly what this signifies. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. To chart a DSY. Let's get acquainted with DSY, or Big Tree Cloud Holdings Limited. This company operates in the consumer defensive sector, specifically within household and personal products. They manufacture and sell personal care products, including sanitary napkins, panty liners, and sanitary pants under brand names like Big Tree Cloud and Yaliurta. They also offer OEM/ODM services. With a market cap of just $16 million and an estimated float of 1.3 million shares, DSY is a relatively small player. Looking at its recent price action, it's been quite volatile. Today, DSY is down minus 2.60%. Over the last 5 days, it's seen a sharper drop of minus 22.35%. However, zooming out to the last 30 days tells a different story, with the stock still showing an impressive gain of plus 77.37%. Highlight volume data. Now, for the volume data, today's volume stands at very low 20,700 shares. Compare that to its 30-day average volume of nearly 5.8 million shares, 5,784,783 to be precise. This gives us a relative volume of 0x average, indicating extremely low trading activity today compared to its recent past. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why do we care? When you short a stock, you're borrowing shares from someone else, selling them, and hoping to buy them back later at a lower price to return to the lender. The cost to borrow is the annualized fee you pay to borrow those shares. A stock becomes hard to borrow when there is high demand from short sellers and limited supply of shares available to lend. This scarcity drives up the fee. Why can fees exceed 100% annually? It's pure supply and demand. If many people want to short a stock and very few shares are available to lend, the lenders can charge exorbitant fees. For short sellers, these high fees are a ticking clock, increasing the pressure to either cover their positions quickly or see their profits eroded by holding costs. Why the stock is hard to borrow right now? Highlight CTB number. DSY has certainly caught our attention due to its hard to borrow status. Its annualized cost to borrow fee is currently an astounding 701.7%. While its CTB momentum shows a recent decrease of 61 percentage points over the last 5 trading days, indicating some easing from even higher levels, the current annualized fee of 701.7% remains extraordinary. What really exacerbates this situation for DSY is the extremely limited supply of shares available to borrow, a mere 10,000 shares. When you consider DSY estimated float is 1.3 million shares, 10,000 available shares is an incredibly tight supply. Our internal composite squeeze score for DSY currently sits at 41.1 out of 100, a level that flags it for potential attention, combining factors like CTB, borrower supply, and price momentum. Squeeze mechanics explain. For those new to the concept, a short squeeze happens when the price of a heavily shorted stock rapidly rises, forcing short sellers to buy back shares to limit their losses. This buying further drives up the price, creating a domino effect. With DSY, if the price were to move significantly higher, those short sellers currently paying over 700% to hold their positions would face immense pressure. The shrinking supply of borrowable shares, just 10,000 for DSY, means it becomes harder and more expensive not only to open new short positions but also to cover existing ones without impacting the market. This scenario can create a positive feedback loop. Buying by short covering pushes the price higher, leading to more short covering, and so on. It's crucial to remember, however, that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their positions. Dilution risk check. One critical factor to assess when looking at a potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. Even with a high cost to borrow, dilution can provide new shares for short sellers to cover, or simply dilute the value of any price increase, potentially negating the squeeze thesis. For DSY, our check found no recent dilutive SEC filings like SMINUS1, SMINUS3, or 424B in the last 90 days, nor any recent reverse splay. This is generally a positive sign, as it means there aren't immediate known catalysts for share dilution that would undermine a short squeeze scenario. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with DSY? Keep a close eye on the cost to borrow rate. Is it staying elevated around that 700% mark, or continuing its recent downward momentum? Monitor the shares available to borrow with only 10,000 shares currently available. Any further tightening could increase the pressure significantly. Pay attention to DSY volume. Today's volume is a mere 20,700 shares, a stark contrast to its 30-day average of nearly 5.8 million shares. This Xerox relative volume indicates extremely low current trading activity, which can either mean lack of interest or extreme liquidity, double-edged sword that can lead to sharp moves and low volume if sentiment changes. Also, continue to monitor its price action, especially after a significant plus 77.37% gain over the last 30 days despite recent dips. DSY, Big Tree Cloud Holdings Limited, presents an intriguing case study with its exceptionally high cost to borrow, extremely limited share supply, and clean dilution record. While these factors can create the conditions for a short squeeze, they are by no means a guarantee. Always conduct your own thorough research and understand the risks involved with highly volatile stocks. This channel is here to educate, not to advise on specific trades. If you found this deep dive helpful, please hit that like button, subscribe for more unique stock analyzers, and let us know in the comments below what other stocks you'd like us to cover. Thanks for watching, and happy learning!